This is the Leadership in Insurance podcast, brought to you by FinPro Search Partners.
Insurance companies are businesses and they need to look for the long term and be sustainable.
We went from 0 to 1 and now it's going from 1 to 100.
Insurance as a concept, as a kind of service, is brilliant. The execution is what we're looking at now.
I think the companies that are going to succeed are the ones that are going to understand and master the art of intent.
When we talk about innovation, we lean too heavily to think about technology and we don't think about creating a culture of innovation.
I think innovation is essentially continuous improvement of existing processes and platforms and product.
Right? It's got to be easy. It's got to be seamless.
Good morning and welcome to the Leadership in Insurance podcast. I'm your host, Alex Bond, and I'm very lucky today to be joined by Jane, who's Principal at Information Capital Partners. Jane, well, it's not morning where I am.
Stop right there. It's Information Venture Partners.
Good morning and welcome to the Leadership in Insurance podcast. I'm your host, Alex Bond, and I'm lucky today to be joined by Jane, who's Principal at Information Venture Partners. That I very nearly got wrong, but I've got corrected really early on, so we've got it right. Jane, thank you for joining me. How are you?
I'm great. Really nice to be here. Yes, and we are the other IVP. There's several funds whose names are abbreviated as IVP, but we of course think we're the most important one, but you know.
Yeah, I think it's tricky, isn't it? When you're in you're in venture, you're in finance, it's like how you get to the name. It's like, we're FinPro Search Partners, and then people always think that we're a division of Marsh, and they go, "Oh, you work in the finance." And it was like, no, that's not us. And but yeah, differentiation is very difficult to do. But that's probably quite a nice lead-in because, just for the people at home, if they don't know IVP, the IVP, it'd be really good if you could introduce yourself and then obviously introduce the fund.
I'd be happy to. So we are a fintech fund. We are based in Toronto, Canada, but we invest across North America. Our sweet spot is Series A. We do some odd seed investments in Series B, but really Series A stage is where we focus. We typically lead our investments. Our thesis areas include, first and foremost, we're investing in technologies for financial institutions, such as banks, insurance companies. We also invest in embedded finance, payments, and everything around the kind of the function of protecting the function of finance and any financial processes. What can I tell you about myself? I personally have been a venture investor for the last, oh my goodness, almost a decade now. I actually came from growth stage investing. I was at Georgian Partners previously, and then I came to earlier stage focused thematic investments. I've actually made some investments into technology for financial services before. Being in Toronto, it's like people talk about Toronto from the finance standpoint. It's the northern capital of finance. You think about New York being south of the border from us, and Toronto here, finance and financial services is probably the biggest industry here frankly, in Canada. So it only makes sense that we chose to focus on this sector. I previously worked at Bain & Company. Again, lots of my clients were in financial services and in insurance industry. I did some strategy work with insurance organizations and banks, some work in customer loyalty. And before that, my background is in technology. I started my career as a software engineer. I worked at Xerox on their services side in business process outsourcing. And actually, quite a few of the clients that we serviced then were in financial services industry, such as insurance and banks. There's a lot of paper-driven processes and document-driven processes that these organizations still do to this day. And so throughout my career, I focused quite a bit in this financial sector, and but again, with my technology background, I'm very passionate about technology, about software, always follow the latest trends. At Georgian, we actually spent quite a bit of time investing in AI specifically. And at IVP, I have recently made an investment. I'll talk about this again, and is a company that is using AI in Insurtech specifically. So that's about me and about our fund. But if there's any specific areas you want me to go deeper into, let me know.
Yeah, of course. Yeah, you've opened that up for me nicely. I think that's what's interesting. So, we're an insurance and insurtech specific podcast. So, yeah, we're always kind of going through that lens. But, obviously you've got a broader lens than that. So you're looking at the wider fintech space. I saw that you announced an investment very recently into Wisedocs. I'd love to hear a bit more about that. But it's quite a turbulent year, 2 years probably for insurtech investment, and I know probably broader tech investment. But I wonder, how has the wider kind of fintech environment changed? Have they had similar challenges? How has that kind of changed the dynamic of what you potentially look at for the portfolio?
So from the big picture insurance standpoint, I would say an insurtech standpoint, I would say the first wave of insurtechs, like back maybe like a decade ago, were actually insurtechs with the biggest vision and ambition, if you will. Companies were actually, and founders of those insurtechs were trying to build insurance companies from scratch, like full stack, end to end, basically doing every piece of the insurance process from underwriting to paying out claims, investing, looking for customers. And what happened is that very quickly, majority of these organizations realized that it's actually very, very difficult undertaking, because on the one hand, it's a very capital intensive industry, right? Insurance. And if you're trying to build an insurance company from scratch, you need to invest quite a bit of time and effort into capturing your customers. This is a direct to consumer model. You need to find the customers, and you need to price the risk correctly. That's where your data innovation comes into the picture, your technology innovation. And then you need to learn from experience that actually paying out the claims is going to be impacted by inflation, for example, right? Your claims will get bigger, and you have to really match that price to risk correctly and price the products correctly, acquire the right customers. And well, you can imagine the result. You know the result of that is a lot of companies have struggled with this business model and have since pivoted into more of an embedded insurance model. Hippo would be one such example. There's some companies that are actually still succeeding at building this like full stack technology first insurance companies. Lemonade is one of them. Kin is a company that raised at $1 billion valuation last year and seems to be growing well and maintaining healthy loss ratios. But now what we're seeing is that there's a lot more insurtech founders that realize that building an insurance company, insurtech company from scratch in this B2C model is just, it's very hard. You need scale, you need a lot of capital. And now that capital is much more scarce and the interest rates have gone up, it's much harder to raise venture capital. Debt is much more expensive. So people are really starting to move toward these B2B embedded models where they sell some kind of a tool to insurance companies, primarily traditional ones, but in some cases, even some insurtechs. So that's kind of the biggest shift I probably see, and I expect this trend to continue. This is why we spend so much time looking at embedded insurance and also at, again, technology for financial institutions, technologies for insurance companies.
Do you think it was ever a venture investment to back risk-bearing full stack insurance companies? Because I look at it and go, I don't think you're ever going to get the multiples you want to see because it's too difficult to build like in a short period of time. Like the venture window versus like the return ratio. I'm not saying you can't build a brilliant business. I'm just saying, is it a place for venture to play? Because it doesn't appear to be for me, but then I'm not a venture investor, so I'm just sitting on the sidelines.
Alex, to be perfectly honest with you, I saw the first full stack Insurtech companies raising capital back in 2015. And at that time, I was doing exclusively SaaS investing, and I was scratching my head thinking, like, how's that going to work? Like, how much capital they need to raise? But apparently, these companies have found their backers. So it really depends, I suppose, on well, in some cases, even the size of a venture fund. Do they have deep pockets to continue funding this business down the road, right? So you need to have a sizable fund. So I'm not going to criticize the VCs that have made these investments, again, because of their particular investment thesis or their capital availability. But for me personally, I could never fully get comfortable with that type of investments, just like you said, for the reasons that you described.
Yeah, exactly. I mean, look, and some of them went public, so I'm sure the funds did very well out of them. But they've not really performed since then. So you kind of go, well, this is probably not a failed investment for the venture, but it probably justifies that it's not a long term view. And I've always been, I do some angel investing. I've talked about this before, and the stuff that I'm interested in is it solves very specific, discrete solutions for insurance companies. Like it takes away a pain point we know that exists. And therefore it solves the problem that there is probably people that do that role now manually, and we're taking away manual solutions. It just seems like and that's my thesis, my lazy thesis. It's like if a human's doing it and we're now going to employ a sort of piece of technology to do it and we're saving money, then that's always been my thesis. But that sort of your sort of broader description of the thesis sounds closer to a lot of the kind of private equity funds that we might talk to. So they're interested in owning the plumbing of the insurance and financial services industry. Is that a kind of fair comparison, do you think?
You can call it that way, but generally, I do like solutions that are improving specific process and bring clear ROI for insurance companies. And again, if you think about big picture, like where the Insurtechs are gonna help insurance companies, right? Like on the one hand, it's your risk and underwriting and pricing. And on the other hand, it's your expense reduction, right? So there's these two big buckets, and there's different estimates by different experts, but people do foresee at least like 20 to 50, up to 50% reduction in expenses and costs, both on claim side and on an expense side of insurance companies through usage of insurance technologies. And I've always seen, like you said, a tool that can solve a very specific part of, let's say, claims processing that brings very tangible, very quick value to insurer is an easier tool to underwrite. Of course, there's a question when you're only solving one little piece of the overall workflow, is like how sticky your solution is and how it embeds into all the other technologies that this insurer is using, how to actually, again, build this moat so that you're not being replaced with a new mousetrap when it comes along. That becomes a question. As opposed to like when you are full stack and when you're automating the full process, it's much harder to sell because, again, you need to think about changing much bigger part of the insurance workflow, integrate with more systems. It's a harder sale, but once you're there, you're much more sticky. But yeah, that's kind of the difference. There's pros and cons.
Yeah, no, I get it. Some of the conversations we've had previously with VCs is like, if your solution is too discrete, it's like you then become a feature of a bigger platform. You're just literally serving a feature focus, and then but of course it's an easier exit because you can be acquired and there's multiple routes out, which is it's such a fascinating dynamic. And we talk about venture a lot on the podcast, and from our business, I mean, we're a headhunting firm, we're a research firm specifically for Insurtech, and we always describe it as kind of blood and oxygen. That kind of that's what you need to kind of put the life into these businesses. But I was always struck by when I first started working with venture how much individuals matter. Firstly, from the VC community, it's much more collaborative than I think I thought to start with. There's a lot more open conversation. But when you're backing an investment, you see hundreds of pitches, but ultimately you were looking for the right team, right, and the right business. How much does that play a part in the kind of decision? And I suppose to give it some sort of life, I don't know if Wisedocs was an investment you led or but like why, for example, Wisedocs is why is that an investment that you made? And what about the team there that kind of really leaps out off the page and made you run check?
Lots of great questions packed into this. Absolutely, team matters a lot when we look at investment. The earlier the stage of the company, the more you pay attention to the one person, which is the founder. Down the road, the founder can be even replaced with a professional CEO, but it's more like the team, really, like, is the team there? A stage where we invest, we're usually dealing with the founders. And yes, absolutely. And people talk a lot about product market fit, and that matters a lot for us. Absolutely. We looked at the size of the market. Absolutely. But we also care about the founder market fit, right? And we do try to understand how much relevance, how much relevant experience, maybe the founder lives through this pain point before, like how much, because as an entrepreneur, you need to be resilient, right? You will go through so many ups and downs, like how committed you are really to solving this problem and all the headwinds you're gonna experience, right? So there's an example for Wisedocs. So the founder, Connor Aitchison, so he actually used to serve in Canadian Armed Forces, first in infantry, and then he was moved to a healthcare administration unit, and he worked there for a number of years. And he actually saw firsthand how the veterans that come back from deployments and they have injuries that they got during their years of service, and they're submitting some kind of either disability or health claims. And Connor just realized like how long it takes for insurance companies to process those claims, what a painful way that is for veterans to live in uncertainty, not know if you're going to be covered, because like those injuries can be like really life altering, right? So and those were literally his friends that he knew, and it was so clear to his heart, and he really made this his mission to improve that health claim processing. And that's why he launched Wisedocs, and he's very, very committed to its mission. And it's, again, like the scope of the solution has went broader than just veterans, but that was like why. So that big why and deep understanding of the pain point, absolutely, that mattered for us.
Yeah. I think you raised an interesting thing there while we were discussing. I was really struck by the power of the storytelling. And like, how much does the ability of a founder to like storytell impact their ability to fundraise?
Storytelling, well, it's pitching, it's sales, right? When you're fundraising, you need to tell the story for sure. And you'll need to tell lots of stories, because the story of how you came up with an idea is not enough, right? You need to prove that you actually build an interesting differentiated solution. And again, the later stage investment we're talking about, the more you can have actually numbers and facts supporting your storytelling. In the early stage investing, it's like literally all about your storytelling. The later stage, again, when you have the working business, when you have customers that can speak to the value of your solution, where you have proven financial metrics. Storytelling remains important, but again, it has to be supported by the numbers, not contradicted by the numbers. So you can look at both. But well, luckily, Wisedocs had both, both the story and the numbers, and happy customers.
Yeah. Yeah, that makes sense. Yeah, it's yeah, you can't run away from the evidence. It's like I've said about some of the full stack carriers. It's like you can't outgrow bad underwriting. You know, you can't outrun your loss ratio. Which is
Yeah, exactly. No story will help you.
yeah, you can sell as much as you like, but you can sell a lot of bad insurance quite quickly. Yeah, when you talk about fintech versus insurtech, um, how much do you see from an insurtech perspective versus kind of broader fintech? And I suppose I'm quite interested in seeing, like, are there specific tranches within fintech that you're seeing a lot more of at the moment?
A lot more of, I guess, embedded finance is still a very big and important trend, and it does touch on embedded banking, embedded wealth management, embedded insurance. It's embedded payments. It's basically companies building infrastructure to enable others to deliver financial services. So that becomes it remains a very important trend. Now, with the advent of Gen AI, and again, it's a new generation of AI. Like I've been watching the AI trends for many years, and I continue to be super excited about every new iteration. We are really, it's like, you know how A16Z says that, oh, every company is now going to be a fintech company. So I think that saying needs to be tweaked to say every company is now going to be AI-enabled fintech company.
Yeah.
So we're going to see so many use cases, and Insurtech in particular, right, where AI will be used more and more and more. And again, Wisedocs is a great example of using AI for claims processing. Mm-hmm. Again, look at the broader trends that are interesting. Maybe this one is, again, going back to Insurtech specifically. There's the usage of connected devices, both in health and Insurtech and in PNC, is still yet to gain full momentum as it actually should. And I think the idea of more like risk prevention as opposed to risk pricing, right? Like if everybody Apple Watch or some kind of a wrist device to track their steps and exercise, but can this be used to improve healthier behaviors and actually improve health of people before they need to submit those medical claims? And similarly in telematics, right? We continue to see the use of telematic devices, not just to adjust the price of a policy, but again, maybe to coach the drivers on better driving behaviors so that, again, they don't get into an accident and they don't have to submit the claim in the first place. So that like IoT connected device category is going to continue. And then, of course, like across all financial technology and InsurTech, fraud prevention and compliance are two very big themes. There are some other interesting pockets. I can talk for hours, but let me know.
Yeah,
no.
No. So we always have to draw a line somewhere. But no, I think those are some great things. And everything is so interlinked, isn't it? Because I was thinking as you were talking about embedded, and then the connected devices thing, for example, like embedding and connected devices goes hand in hand. You know, we were talking to an Insurtech the other day, and we were discussing like embedded, and I just said, for me, embedded is just a reflection of the society that we've created. You know, like if we think about just even our use of phones, and you know, you grow up using a phone, and you can do certain things on a phone, and then now I can do everything on my phone, and you know, we were talking to someone where the revolutionary thing was that as soon as they issued me an an insurance policy document that it was downloadable into my wallet. I mean, that should not be a revolutionary thing, but it was. And I thought, yeah, that's because it's trying to embed these transactions into how I live my life now, not trying to get me to change my behavior to suit your business. And that's how I truly think about embedded is less about the transaction, the buying, the purchasing. It's like, how does that fit within my life truly? And secondly, the embedded thing is to be able to sell me an insurance product that I don't even realize is an insurance product. And we had like Armored was a great business over in the UK that, you know, they sell a security device, but they also have if something gets stolen and you've got our security device, we give you a £500 voucher to go and hire tools. It's essentially a sort of warranty type insurance product, but no one's telling someone it's an insurance product. And I think there's so many opportunities to evolve kind of products in that space, and they all kind of match up. Because I think, do you think insurance has been guilty for a long time of kind of almost sitting in this silo and saying, we've got our own little world, we do things like this, and you're just have to adjust to us rather than adjusting to the world around it?
That's a great point, Alex. And it goes back to the whole, like, again, concept of embedded insurance is that we used to think about all financial services is that there is this institution out there, a bank or insurance company. And if I need something to do with my money, whether to invest or protect, which insurance is, I need to go somewhere to that place, right, to give me that service. But the advent of technology and embedded finance in particular showed us that we can actually deliver those financial services to people right in the natural workflows. Like, why do I need to go to a bank separately when I'm buying a home? It's all about my home. Why do I need to go to some like other place, right? Is there a workflow tool that allows me to actually, once I selected my house and trying to bid on it, I at the same time submit an application for a mortgage right there, right? And submit an application for insurance once I actually got that house and get it digitally, right, within that same workflow. Or maybe your example, closer to your example, is e-commerce checkout. I'm buying, let's say, I don't know, maybe a new phone online through an e-commerce website. And right there, I get offered an insurance, some kind of coverage and protection on the device that I'm buying, right? And it's right there, right in that process. I don't have to think, oh, I need to call the insurance company and ask them if they're going to insure my phone if I drop it. So yeah, absolutely. There's this. That's what embedded solutions do for you, is to simplify consumers' life.
Yeah, I think where we've been under-resourcing slightly, and I think that example's a good one, is the buy a mobile phone, get the insurance. I've never once bought the insurance at that point. And because the other thing that you've got now as a consumer is choice. I mean, I'm one of these terrible people that every time I go and buy some electronic goods like of significance, I don't know, like washing machines or a TV, I'm in the store because I want to see the stuff. I want to see it in front of me. But then I've got my phone and I'm going, you know, can I get this at that price? Can I do this? And so I think some of the embedded feedback I get is that embedded's great, but no one's selling any policies. And I think one of the challenges for me is that I want to see choice. So I want an opportunity to buy my insurance when I buy my phone, but I want 5 quotes and I want to be able to pick because I live in a world where I have choice. So I think there's still a gap for me in the way that we're approaching consumers in the world of insurance. So we're trying to bend them still to our will, going, well, we've offered you an insurance policy. It's like, yeah, but I don't know that's the best insurance policy, so I'm not going to buy it. And I don't think I'm unusual in that. I think there's a slight mistrust of going, well, if you're selling me this, I think I can get a better deal, probably. So I think there's a way to go in embedded, but embedded's the way, but it's also like I think there's a gap at the moment between, you know, and there's the same for flights. I literally booked a flight this morning and they offered me cover and I got it for 25% of the price for pretty much the same cover. So I was like, well, that's where we're letting ourselves down. We're still kind of trying to sell at point of sale in I suppose with a lack of clarity. So I think there's some opportunities there. Taking it forward, we're at the start of a new year. It's the end of January, which I cannot believe because it's just gone. Like I've blinked and I've gone. What are you excited about this year in terms of kind of talking to people? We've talked embedded and we've talked about sort of connected devices. Have you seen anything really unusual lately that you've kind of been interested in investing in? I'm always after the weird and wonderful that you may have seen recently.
Ah, weird and wonderful. I don't know how weird and how this goes back to like your point of maybe embedded, but I'm actually like seeing some curious like very like niche specialty insurance products coming up. And like maybe the most obvious example here is cyber insurance.
Yeah.
I think there's been quite a bit of turmoil in this industry because the cost of those cyber incidents have been much higher than people anticipated. So there's been a battle between those insurers and companies that buy these insurance policies. So I think that industry has ways to go to mature and figure out the correct way to price this in this type of insurance. I generally believe, like, because unfortunately cybercrime is here to stay. Cyber protection solutions are here to stay, but cyber insurance is gonna gain importance. But there are also some like really niche specialty insurance products that I was seeing. It's like insurance products for renewable energy and carbon credits. There's some like crypto and blockchain related insurance products. Like I'm yet to really fully understand, and this is kind of like the areas of where I'm spending the time researching right now, trying to understand what's going on there. That's like sounds interesting.
Yeah.
But those would probably be some examples of the
No,
weird
no.
niche things.
And then, yeah, the good ones, like some of the net new products. And yeah, we've had a couple of carbon credit related in Insurtechs on. We had a couple of like crypto related Insurtechs on ensuring that. And I think cyber's a fascinating space. And, what I'm interested about is to see what the trend is going to be towards individuals taking cyber cover on a personal basis. It's the first time I've taken any out specifically because I realize so many of my assets are digital and so many of are kind of like, and certainly the access to is digital. And it's like, it's better to have coverage, and our lives are so digital now that I think there's so much of a way to go. But the challenge is it keeps being redefined as to what's covered and what isn't. And I think it's such an evolving space. But the carbon capture, particularly renewable space, I think's absolutely right. Is a hugely interesting sector.
Very interesting, yeah.
Yeah, and then of course, like the AI thing that you mentioned right at the start. I think every company being an AI company. I mean, I've mentioned before, like we're always looking at new tech, and I saw the first new tech for our industry that I went. It was genuinely incredibly effective. And essentially it was a sort of 24-hour resourcing tool, and it wasn't 100% accurate, but it was pretty good. And we were starting to go, okay, how does that change our business? And it does, and it will. And it will be relationship driven. Um, then one thing that gets asked all the time, and particularly because of the stage you invest, so Series A, we get lots of like seed round businesses that are kind of growing, expanding, and they're always looking for Series A investors. What is the best way to kind of reach out? Because I think that's something we've not talked about enough. It's like if someone's got a deck and they want investment, do they need to have a friend of a friend intro? Do they just cold email you, or what's the best way to approach that kind of outreach?
I try to respond to a cold outreach as long as it's on thesis, right? I do get a lot of random emails about, oh, do you want to invest in my medical device? Well, if you just look at my web page, right, I'm a fintech investor. But as long as it's on thesis, right? But even those that offer me medical devices, I try to respond to them saying, sorry, we're a fintech investor. Of course, warm intros always put things on top of my priority list. And every time you actually talk to a VC, you should absolutely, if you're raising, ask, okay, maybe we're not a fit for you, maybe not at this stage. Is there someone else you can suggest we talk to? We're actually typically happy to make those introductions because, again, we want to be value add both to the founder but also to our friendly VCs, right? They always appreciate a deal flow we send. It's always on the opt-in basis, so I would send an introduction and say, would you take it? And it's up to them to take it or not. I can't force that introduction. I don't do cold introductions, but generally, yeah, that's probably the route I would suggest. And the VC ecosystem, it's pretty closely knit. Like people know each other in the industry. So yeah.
Yeah,
And especially yeah.
Yeah, it's
Yeah, go ahead.
I was just going to say it's quite similar to my industry in that I have a particular niche that I work in, and if you fit outside, I was having a conversation genuinely about an hour and a half ago with an incredible C-suite executive, but what they're looking for isn't really my world. They're too probably heavy hitting for my stage. But I know a couple of really good firms, and the first thing I did is I'm happy to make those intros, and I think it's collaborative because it's much more collaborative than you think, and I think that venture community is a lot closer than you think. The amount of times that we're at events and everyone goes, "Oh, I know that person,"
Yes.
and it's deal flow. Everyone needs that kind of deal flow. Um, uh, but yeah, what are you excited about? And what are we missing? I don't want to miss any opportunity for you to kind of promote one of your investments that you're really excited about for 2024.
Well, maybe I can kind of go back for a second to this like new iteration of AI products and how there's two types of companies, right? There's infrastructure AI, or companies that are actually developing AI algorithms for others to use. And then there's what I call AI-enabled companies. And majority of the fintechs we invest in, even if they are AI, right? They're typically AI-enabled. They are using some third-party AI models, but they will then go ahead and build their own models on top of those. And of course, it's all about the data, right? Because at the end of the day, it's what is a moat for an AI-enabled company? It's not AI itself, but rather the training the data sets that they're using that AI. And it's like, again, like you put your child in early learning program, it's when they're super young, they're going to be likely ahead of their peers by the time they hit grade 3. I don't know, making stuff same idea. The sooner you start training your algorithms on a certain data sets, you actually have the benefit of having seen more, say, health related documents to be better at assessing and categorizing, summarizing, extracting insights from a health claim. So that data, the more documents you process, the stronger your solution becomes. Is still continue to be like, that's why I'm like, when I'm assessing AI companies, I look a lot. It's like, are you infrastructure? No. You're AI enables. Okay. What's the data set? What you own? What's proprietary in that data set? And how that data set over time, how you will accumulate maybe more, like the more claims you process. Previously, we invested in Tractable, which is AI-enabled claims processing, but for auto insurance. And they spend a lot of time on actually like photos and image recognitions for auto accidents. Same idea, right? Like the more time you spend, the more images your algorithm looks at, the better it is at doing that. And that's what really becomes the moat. So I'm quite excited about seeing those kind of use cases. Other use cases for AI is like more on how to market yourself, customer support, maybe even some product development. But efficiency gains is kind of like number one area that we're going to see. I think Insure is benefiting from this trend and from this technology.
Yeah, if there's one industry that needs some efficiency gains, I think it's going to be the insurance industry. So, no surprises there. Jane, thank you so much. You've been super generous with your time, and it was it was lovely to have this conversation. So, thanks very much for being a guest on the podcast.
Alex, it's been so much fun. Thank you so much for inviting me.
Thank you.